Right. Let's start with recording.
Recording in progress.
Yes, no. Papa 2 CVP analysis quick revision just ఒకసారి. సో ఫస్ట్ ఈ చాప్టర్ లో డెసిషన్ మేకింగ్ ఎలా టైప్స్ ఆఫ్ డెసిషన్స్ ఇవన్నీ ఉంటాయి. ఫస్ట్ వన్, సో టైప్స్ ఆఫ్ డెసిషన్స్ స్మాల్ ఉంటుంది, ఇండివిజువల్ ఉంటుంది, అండ్ ఐ మీన్ స్మాల్ డెసిషన్స్ ఉంటాయి, లార్జ్ డెసిషన్స్ ఉంటాయి, ఇండివిజువల్ ఆర్ గ్రూప్ ఉంటుంది, షార్ట్ టర్మ్ లాంగ్ టర్మ్ ఉంటాయి. సో why decision making is to accept a new product or to continue with the existing product or not, to decide whether to continue or not, or price setting కోసం, or risk management కోసం చేస్తూ ఉంటాం. How decision making will take. So based on analysis, we take the decisions. So the analysis, the two types of techniques are there for that analysis: cost CVP analysis, cost volume profit analysis, and margin analysis. ఇవి ఉంటాయి. అండ్ నెక్స్ట్ వన్, సో సివిపి అనాలిసిస్ చేసేటప్పుడు డెఫినెట్ మనం ఏంటి సేల్ ప్రైస్ ఎలా ఏంటి ఇవన్నీ ఫిక్స్ చేసుకుంటూ ఉంటాం. సేల్ ప్రైస్ ని అనాలిసిస్ చేస్తాం, వాల్యూమ్ ని అనాలిసిస్ చేస్తాం, ఇవన్నీ అనాలిసిస్ చేస్తాం. సో వాటిలో సంబంధించి కొన్ని టర్మినాలజీ ఇస్ వెరీ వెరీ ఇంపార్టెంట్. ఫస్ట్ వన్, కాస్ట్ టర్మినాలజీ. కాస్ట్ అంటే ఏంటి? రిసోర్సెస్ ఎక్స్పాండెడ్ ఎంత సంబంధించాం ఫర్ ఏ స్పెసిఫిక్ ఆబ్జెక్టివ్, దాన్నే కాస్ట్ అంటారు. సో అండ్ నెక్స్ట్ వన్, ఫిక్స్డ్ కాస్ట్ అంటే ఏంటి? ఫిక్స్డ్ కాస్ట్ రిమైన్స్ కాన్స్టెంట్ ఈవెన్ ద యాక్టివిటీ చేంజెస్. సో ఫస్ట్ ఫిక్స్డ్ కాస్ట్ టూ టైప్స్ ఉండొచ్చు: కమిటెడ్, డిస్క్రిషనరీ. కమిటెడ్ అంటే ఏంటి? ఆల్రెడీ వీ హ్యావ్ కమిటెడ్. ఎగ్జాంపుల్ డిప్రిషియేషన్. డిస్క్రిషనరీ అంటే ఏంటి? సో వీ కెన్ స్టాప్ దట్, ఇట్ ఈస్ అవర్ కంట్రోల్. ఎగ్జాంపుల్ సాలరీ టు ది staff. So next one, so variable cost. Variable cost, actually it is varies to the with the respect to the production. It varies directly proportionate to the production. So relevant range లో ఉంటుంది. relevant range లోనే ఆ బిహేవియర్ ఉంటుంది. If range changes, then the behavior will change. So example, direct material, direct labor, variable manufacturing overhead, variable selling overhead, variable administration overhead. So next, total cost means total variable cost plus total fixed cost. Next one, cost driver. Cost driver means the factor which affects your cost is nothing but cost driver. For example, I am the man who is producing benches. Number of benches produced will increase my cost. So my cost driver is number of benches produced. Okay. So cost object. Cost object means anything anything for which the cost is accumulated is nothing but cost object. I am the man which is producing bench. So my cost is accumulated to the bench. The bench is nothing but our cost object. Then what is the relevant range? What is my capacity? I can produce up to 100 benches. So 100 benches is my relevant range. If I want to produce more than 100 benches, I need to take another Godam. Okay. Relevant range is the range of activity in which variable, fixed, and all functions remains constant. So revenue means it's an inflow, it's nothing but sales. So revenue, how can you calculate revenue? Sale price into number of units sold. Next one, revenue driver. Revenue driver means factor that affects the revenue. For example, so number of units sold is a factor which increases my revenue and which decreases the revenue. If number of units sold increases, the revenue will increase. Number of units sold decreases, revenue will decrease. Next one, operating income. Operating income is nothing but the formula. Sales minus COGS is a gross profit. Gross profit minus operating expense is a operating income. Operating income is nothing but total operating revenue minus total operating cost. Operating cost means COGS plus admin plus selling and administration expenses, excluding interest. Interest is the other expense, not operating expense. So net operating income is we need to take the tax effect. So operating income minus tax on operating income, nothing but operating income to 1 minus tax rate is the net operating income. Finance cost is not taken into the operating cost. So activity level is the output level. What is the output I produce? Even though I am enabled to produce 100 benches, I have produced only 70 benches. 70 benches is my activity level. It is my output. So number of units produced is nothing but activity level. And CVP analysis assumption, we assume that it is a linear assumptions and certainty is there with respect to fixed cost and variable cost and that total cost. And single product, in the case of defined products, the defined mix is the product mix is defined, not changed along with the production, and production is equal to sales. We do not consider inventory here while taking analysis. Cost behavior. So the cost behavior is very very important. Fixed cost in total is always constant. Fixed cost per unit changes. Variable cost in total changes. Variable cost in per unit, variable cost per unit is always constant. Variable cost per unit is always constant. So variable cost examples: direct material, direct labor, variable overhead, sales commission, shipping cost, royalty. These are all changes with the production. Fixed cost is constant. Example: depreciation, rent, insurance, salaries, advertisement. Those are examples of fixed cost. Next one, fixed cost graph, variable cost graph, one graphs, one ఒకసారి చూసుకోండి. These are questions and graphs. So very important formulas. So formulas is nothing but profit. Profit is equal to sale price per unit minus variable cost per unit into number of units minus fixed cost is a profit. So where contribution per unit is equal to sale price per unit minus variable cost per unit. Next, contribution is equal in total is equal to sale price minus variable cost. Contribution is equal to sale price minus variable cost. Sales minus variable cost, nothing. So profit is equal to contribution minus fixed cost. Required units is equal to profit desired profit plus fixed cost divided by contribution per unit. CMR ratio, contribution margin ratio is equal to contribution by sales into 100. Required sales in total in value is equal to profit desired profit plus fixed cost divided by contribution margin ratio. These are the formulas, very, very important. We have practiced most some of the questions in these formulas on these formulas. Ivanni practice చేయండి. So next, sir, what is the formula BEP? BEP, where the point where the no profit, no loss is nothing but BEP. Above BEP, profit. Below BEP level, loss. It can be expressed in dollars or in units. BEP units is equal to fixed cost divided by contribution per unit. BEP value is equal to fixed cost divided by CMR ratio. Right? This is regarding BEP. BEP. Next, MOS. MOS is nothing but the excess sales over BEP. It can be unit expressed in units, value, and percentage. So the overall formulas is equal to required sales is equal to required profit plus fixed cost divided by contribution per unit. Required sales value is equal to required profit plus fixed cost divided by CMR ratio. MOS units is equal to excess of BEP. Nothing but so actual sales minus BEP sales. Actual or planned sales minus BEP sales. MOS ratio is equal to MOS divided by planned sales. BEP ratio is equal to BEP divided by planned sales. MOS ratio is equal to 1 minus BEP ratio. BEP ratio is equal to 1 minus MOS ratio. BEP ratio plus MOS ratio is equal to 1. Profit ratio is equal to, very important formula, profit ratio is equal to MOS ratio into CMR. So MOS units is equal to profit divided by contribution per unit. MOS value is equal to profit divided by CMR. So, and CMR ratios for exclusively ratios formula. CMR is equal to contribution divided by sales. So variable cost ratio is equal to 1 minus CMR. CMR is equal to 1 minus variable cost ratio. Variable cost ratio plus CMR ratio is equal to 1. It is always 1. So MOS ratio is equal to MOS divided by planned sales. BEP ratio is equal to BEP divided by planned sales. MOS ratio is equal to 1 minus BEP ratio. BEP ratio is equal to 1 minus MOS ratio. BEP ratio plus 1 MOS ratio is equal to 1. So ఇవన్నీ formulas already. We have done all the questions. So it is required ratios and all those things we have done. All the questions we have practiced. Next, in case of at BEP, this is very, very important. At BEP, contribution is equal to fixed cost. At BEP, contribution is equal to fixed cost. Very, very important. So net operating income is equal to operating income into 1 minus tax rate. Whereas we can find the net operating income from net operating income. Operating income is equal to net operating income divided by 1 minus tax rate. So these are the overall formulas. Profit is equal to sale price per unit minus variable cost per unit into number of units, nothing but contribution minus fixed cost. Contribution per unit is equal to sale price per unit minus variable cost per unit. Contribution is equal to sales minus variable cost. CMR ratio is equal to so contribution margin ratio is equal to contribution by sales into 100. Profit is equal to contribution minus fixed cost. Required sales is equal to required profit plus fixed cost divided by contribution per unit. Required sales value is equal to required profit plus fixed cost divided by contribution margin ratio. So BEP units is equal to fixed cost divided by contribution per unit. BEP value is equal to fixed cost divided by CMR ratio. MOS units is equal to excess of BEP. Planned sales minus BEP sales. MOS ratio is equal to MOS divided by planned sales. MOS units is equal to profit divided by contribution per unit. MOS value is equal to profit divided by CMR. So in case of mixed products, we need to find the contribution of individual product. This is step number 1. Step number 1, find the contribution of individual product. Step number 2, find the weights of the individual product. Step number 3, multiply the contribution with the respective weights. Step number 4, you get the overall contribution. So use that overall contribution while calculating BEP and MOS. So right. So while you are shifting in case of mixed products, while you are shifting from high margin units to low margin units, the operating income will fall even though sales rises when compared to last year. While shifting from low margin to high margin, the operating income will rise even though sales falls when compared to last year. Semi-variable cost. Semi-variable cost is a mixture of variable and fixed cost. How can you segregate the semi-variable cost into fixed and variable? Step number 1, find the variable cost per unit. The formula for variable cost per unit is difference in cost divided by difference in units. difference in cost divided by difference in units. Then you get the variable cost per unit. And find the variable cost in total, and reduce the variable cost total from the total cost, then you get the fixed cost. Okay, this is how we can segregate. Step cost is nothing but increasing the cost in up to some extent it is fixed and increased after that extent. So in a incremental manner, this is nothing but step cost. Sensitivity analysis. If any sale price changes, then what is the new BEP? If variable cost per unit changes, then what is the new BEP and what is the MOS and what is the required sales? All those things is nothing but sensitivity analysis. Next, assumptions. These are all assumptions. We have already done this. This is nothing but a quick revision of CVP analysis. Okay.
Recording stopped.